Joining me now is Northlight Asset Management's Chief Investment Officer, Chris Zaccarelli. Chris, great to see you. Thank you so much for being here. Your reaction to all these market moves and the deal-making underway in Washington?
It's been an incredibly choppy ride, obviously, with all of the tariff announcements and then the possibility of deals. And, that's what markets do. They're pricing in the worst case scenario. If we're going to have broad-based tariffs and it's going to be, very punitive, and if it's going to be held for a long period of time, we could go into recession. But if we start making deals, we start ending up with a situation even better than where we began in terms of having more a level playing field, having trade policies that are a little bit more reciprocal. I think you're going to see a big rebound in the stock market. Now, I don't think it'll happen all in one day, but to your point, it can happen violently. It can happen in a very quick moment. So that's what markets are looking for. They're looking for some resolution from the standoff, the uncertainty. They want to see a path forward. And so if we can make some trade deals, reduce the level of tariffs across the board and make this more of a targeted attack, let's say on China, or targeted approach towards countries that are not treating us fairly, but not treat all countries with a broad brush, I think you'll see the markets rebound and we'll be back to where we were in terms of having a stronger economy and seeing corporate profits increase again. That's what companies are looking for, and that's what the market's looking for.
Well, absolutely, and that's what the sentiment was in my head yesterday and these last couple of days. I think this market wants to go higher, and it's waiting for a news nugget to do so, and is grasping on these deals that President Trump is talking about. Look at the futures right now. I'm wondering if you want to get in here now, or are you waiting for another big sell-off to get even in better prices?
Well, for our clients, we've been just cautioning. First of all, if you're already in the market, obviously stick with it. Those people who are going to cash or panicking are going to lock in losses. But for people who had money that needed to be put to work, we had some people putting money to work yesterday. In general, we still advocating a dollar cost averaging approach. We're not saying put it all in at a specific part, but as you see it go down 10%, 13%, that's a great time to start putting some money to work. Could markets go lower from here? Absolutely. The news flow is going to be changing. Markets are going to be volatile. But at this point in time, we would put some money to work. And yesterday, in fact, we did.
Yields this morning, meanwhile, back above 4%, but nonetheless, you're looking at a decline in the 10-year Treasury yield. I want to get your take, Chris, on yields and what this means. Futures traders are anticipating now at least 4 rate cuts this year. They're fully pricing in a cut at the Fed's upcoming June meeting. And Larry Fink was at the New York Economic Club yesterday saying we're already in recession. And I could confirm that one CEO told me the same thing over the weekend when I was in Las Vegas, saying, yes, we are in recession right now. What's your take on this?
It's a very fluid picture. To the extent that we are in recession already, or at least a mild recession, the Fed will have to act. It's pretty rational to see the Fed or see the markets pricing in, 4 to even 8 rate cuts, depending on the severity of the recession. It's really going to depend on where things go from here. If we are already in recession, it's possible it could be mild and we can come out of it if a lot of trade deals can be made. However, if it turns out the tariff uncertainty is going to last for a longer period of time, or we're unable to make deals, then, if we're not already in recession, I'm sure we'll go. And so I think it's really, it's going to be a binary outcome in terms of the Fed is either going to cut a couple times just to maintain status quo. And as long as inflation is coming lower, they'll kind of do some maintenance cuts. But if we do see significant weakness in the economy, weakness in the job market, then they're going to cut at least 4 times and potentially more. So it'll really depend on what's going to happen with tariffs and trade policy. And of course, on the other end, what happens with tax cuts and deregulation, which are the things that markets are really looking forward to.